I'm now joined for a look at these global markets in London by Graham Bell. He's joining me from Old Mutual Equities, not London. Graham, thank you so much for making the time to join us. It seems as if the big headline for the global markets is, of course, the Fed and the Fed statement. Give us a sense of which way you see this going.
Well, FOMC meetings are always very closely and widely followed, but there's almost zero chance that the Fed will make any change to interest rates at this meeting. At the last meeting, they did mention that global economy was a factor for them, and we saw also the ECB and the Bank of England say the same thing. Has there been a significant improvement in the global economy since then? Well, it's really hard to say that. We've seen some positive data coming out of China. That's true. Credit's been up, house prices are up a bit, car sales have turned up. But the Fed is looking more widely than just China, and I think that they will opt to have no change at this meeting, and they'll also, I don't think, give very much guidance. I think they'll rather leave it to the next meeting in December, and they will then have the employment cost index, which is going to be released on Friday in the USA, which is a very widely watched wages and salaries indicator. The last time it came out, it's a quarterly indicator, it had a very sharp fall and surprised everybody. So the expectation is it's going to pick up, but nobody knows how much it's going to pick up. And that's going to be a very important piece of information for the Fed. And I think they'll rather wait for that to see whether wages are picking up, and that is, I think, one of the most important indicators which will shape their decision.
Graham, given the wait-and-see approach that you think is likely to be adopted, would you then concur with those who are in the camp that says there will be no rate hike this year at all?
No rate hikes in the USA, you mean?
Absolutely.
Well, there's only one more meeting this year, and as I say, it's hard to say. I believe not. I think the Fed won't hike in December. It's a split decision. I think that if they are really concerned about the global economy, as they said, which was a very confusing thing to say, because suddenly, they're looking more widely than just the USA economy. If that is the case, I don't think there's going to be enough information about the global economy by December for them to have changed their minds. And there are quite a lot of other factors. In the US, there's been some weakness in manufacturing. There's quite a big inventory overhang. So it's by no means certain that the US economy is strong enough at this stage to sustain a hike. But as I said, the employment cost index is key, and if that comes in above expectations for the quarter are 0.7% increase, so an annualized about 2.5% to 3%. If that comes in above that, then I think they will certainly be persuaded to move. But aside from that, no, I think no hike in December, and it'll be pushed out into next year.
Another market or economy rather that's in focus with regards to its growth is the UK. We saw that slowing down to 2.3%, but still a market that in the developed world space is doing fairly well. Your take on this, Graham?
Indeed. It was 0.5 in the quarter, so annualized over 2%. The two factors that brought it down were construction, which is sure to bounce next quarter, and manufacturing, which is a bit mixed. But demand in the UK is strong. Retail sales have bounced strongly, and they've been pretty firm for some time, and that should help manufacturing production to recover as well. Inflation is very low, even slightly negative. So the overall tone in the economy is still pretty positive. So Bank of England, this data probably caused the Bank of England to sit back and watch for a little bit longer. That's probably quite true. But at some point next year, the BOE is also likely to hike, but not too early on in the year. I guess they'll wait a little bit just to see how things work out.
Maybe a quick move away from the macro issues and maybe just a quick focus around corporate news, in particular VW. We know that they've had to make provision for those massive fines coming their way, but we are seeing a loss of 3.48 billion euros. That's a big number to stomach, Graham.
Well, they've taken a big charge, and the charge of 6.7 billion euros is bigger than they initially estimated. If that hadn't been the case, they would have had a very good operating quarter. It would have been up about 4 billion euros versus 2.9 of the same quarter of last year. And sales in Europe and the US were strong. But that's exactly the point, is that those two regions are key for them following this disaster. And so the sales data haven't yet picked up the impact of that revelation. So we really need to see what happens in the current quarter to sales in Europe and the US. My feeling about Volkswagen is that the charge that we've seen so far is likely to continue to rise. It's going to be a bit like the disaster in the Gulf, that oil story with BP. I think it's something that can run and run, and it's a long way from being over for Volkswagen. The brand, I think, has been materially damaged, and I think things are going to continue to get worse for them.
On that negative note, things are going to continue to get worse. Graham, thank you so much for your time. That, of course, is Graham Bell, strategist for Old Mutual Equities.